Do you want to make money in 2024 by diversifying your stock portfolio? As an investor, you probably already know that putting all your financial eggs in one basket is a risky move. Diversifying your stock portfolio not only helps to mitigate risk, but also opens doors to potentially higher returns. And in this fast-paced, ever-changing world, diversification is more important than ever. In today's video, we're going to delve into the world of stock portfolio diversification. We'll explore why it's crucial to spread your investments across different sectors, and how international diversification can broaden your investment horizon. We'll also discuss the importance of diversifying over time and how regular rebalancing can keep your portfolio aligned with your investment goals. So, whether you're a seasoned investor looking to optimize your portfolio, or a rookie investor starting your journey, this video is for you. Stay tuned to learn some practical tips to diversify your stock portfolio and boost your financial growth. First things first, understanding what diversification really means. Picture this. You're at a buffet. You wouldn't just load up your plate with only mashed potatoes, right? You'd want a little bit of everything. Some greens, a slice of roast, maybe a spoonful of that tempting lasagna. That's diversification in a nutshell. It's about spreading your investments across a variety of assets to avoid putting all your eggs in one basket. Now, why is diversification so important? It's all about risk management. The financial market, much like life, is unpredictable. Stocks can soar one day and plummet the next. By diversifying your portfolio, you're spreading the risk. If one of your investments takes a hit, you've got others to cushion the blow. It's like having a safety net in the high-wire act of investing. But there's more to diversification than just playing it safe. It's also about potential for higher returns. Different assets perform well at different times. Bonds might shine when stocks are struggling, and vice versa. By having a mix of both, you're poised to benefit no matter which way the market swings. Now, there's a common misconception that diversification means owning a large number of stocks. But it's not just about quantity, it's about quality and variety. You could own 100 stocks, but if they're all in the same industry, you're not really diversified. True diversification means spreading your investments across different sectors, different types of assets, and even different geographical locations. So how diversified should your portfolio be? Well, there's no one-size-fits-all answer. It depends on a number of factors, including your financial goals, your risk tolerance, and your investment horizon. But as a rule of thumb, it's always a good idea to have a mix of stocks, bonds, and other asset classes, and to spread your investments across a variety of sectors and regions. Now that we understand what diversification is, let's dive into how you can achieve it. Tip number 1, don't put all your eggs in one basket. This old adage holds true, especially when it comes to investing. Spreading your investments across various sectors and industries is a savvy move. Why? It's all about risk reduction. Imagine your entire portfolio is tied to the tech industry, and suddenly, there's a tech bubble burst. Your investments could take a significant hit. But if you had diversified, spreading your investments across healthcare, manufacturing, real estate, and others, a downturn in one industry wouldn't spell disaster for your entire portfolio. Different sectors often perform differently under various economic conditions. When one sector is down, another might be up. This balancing act can help stabilize your overall returns. Moreover, diversification across sectors keeps you open to a wider range of opportunities. You never know which sector might be the next big thing. Spreading your investments can be a safety net during market volatility. So don't just stick to what you know, explore and diversify. Tip number 2, go beyond borders. When it comes to diversification, thinking globally can be a game changer. The world of investing is not limited to your home turf. In fact, international diversification can offer benefits that domestic investments may not provide. Consider this. The economic cycles of different countries don't always sync up. When one nation's economy is in a slump, another might be experiencing growth. By investing in foreign markets, you can benefit from these differing economic cycles. Let's not forget about the potential for higher returns. Emerging markets, though risky, can offer significant growth opportunities. But remember, higher potential returns often come with increased risk, so always balance your portfolio according to your risk tolerance. And then there's the added bonus of currency diversification. If your home currency weakens, investments in stronger foreign currencies can help offset these losses. In essence, going international with your portfolio can open up new avenues for growth. Tip number 3, diversify over time. Now, let's delve into the concept of dollar cost averaging. This smart strategy involves investing a fixed amount of money at regular intervals, regardless of the market's current state. By doing so, you end up purchasing more shares when prices are low, and fewer when they're high. Over time, this can help average out the cost per share of your investments. This approach is a great way to reduce the impact of market volatility. Instead of trying to time the market, which is notoriously difficult and unpredictable, you're smoothing out your investment journey. So, rather than putting all your eggs in one basket at a single point in time, you're spreading out your investments. This method can help to moderate potential losses in the event of a market downturn. Remember, consistency is key when it comes to successful investing. By diversifying over time, you're setting yourself up for a more stable and potentially profitable investment future. Scene script. Tip number 4. Keep an eye on the scale. Now let's turn our attention to the necessity of portfolio rebalancing. Picture a scale. When it's balanced, both sides are equal. When it's unbalanced, one side outweighs the other. The same principle applies to your investment portfolio. The goal is to maintain the balance of your investments according to your desired risk levels. You see, over time, some investments may outperform others, causing your portfolio to become unbalanced. For instance, if your high-risk investments perform exceptionally well, they might start to make up a larger part of your portfolio than you initially intended. This could expose you to more risk than you're comfortable with. That's where rebalancing comes in. Rebalancing is the process of readjusting your portfolio back to its original asset allocation. It's like resetting the scale back to its balanced position by selling some assets that have increased in value and buying more of those that have decreased. You can keep your portfolio aligned with your original investment strategy and risk tolerance. But how often should you rebalance? Well, there's no one-size-fits-all answer to that. Some investors rebalance their portfolio quarterly, some do so annually, and others do it whenever their portfolio drifts a certain percentage from their desired allocation. The frequency will depend on your personal investment strategy and how comfortable you are with risk. However, it's important to remember that rebalancing isn't about trying to time the market or chase returns. It's about sticking to your plan and keeping your risk levels in check. Also, keep in mind that rebalancing may have tax implications. Selling assets that have increased in value might trigger capital gains taxes. So it's always a good idea to consult with a tax advisor or financial planner before making any big moves. In the end, the key is to stay vigilant. Keep an eye on your investments, and don't be afraid to make adjustments when necessary. Because remember, investing isn't a set-it-and-forget-it game. It's a process that requires regular attention and adjustments. Regular rebalancing ensures your portfolio stays aligned with your investment goals. To recap, diversification is your best friend in the investment world. It's the life jacket that keeps your investment ship afloat, even when the financial seas get a bit stormy. And in the ever-changing landscape of 2024, it's more important than ever. We've taken a deep dive into the concept of diversification. It's not just about having a variety of stocks in your portfolio, it's about understanding how different sectors and regions react to market fluctuations, and using that knowledge to spread out risk. It's about not putting all your eggs in one basket, but instead spreading them across multiple baskets, each carrying a different kind of risk and reward. We've also explored the idea of spreading investments across sectors. Each sector has its own dynamics and responds differently to economic changes. By investing in a variety of sectors, you're not only spreading out your risk, but also increasing your potential for reward. Think of it as a buffet of opportunities. The more varied your plate, the better your chances of tasting success. And let's not forget about international diversification. In our globalized world, opportunities are not bound by borders. By venturing out of your home market and into foreign territories, you're accessing a whole new world of potential investments. It's like exploring a new city. You never know what gems you might find. Diversifying over time, or dollar-cost averaging, is another strategy we've discussed. By investing a fixed amount at regular intervals, you're reducing the impact of market volatility on your portfolio. It's like watering a plant. Little by little, over time, you can help it grow. Finally, we've emphasized the importance of rebalancing regularly. Like a well-tuned orchestra, every instrument in your portfolio needs to play its part, and sometimes that requires a bit of adjustment to keep the harmony. With these tips in mind, you're well on your way to diversifying your portfolio and making money in 2024. Happy investing!